The next question ultimately comes down to how do you value these businesses? And, a typical valuation metric is the market approach, right? A transaction multiple. We've all heard, pest control companies tend to sell for X times revenue or X times cash flow. And there's a myriad of multiples that just get sprayed around the industry. I would, if I were in your position, avoid thinking about things in terms of multiples and actually try to get a little bit more sophisticated as to how you're valuing this business. I wouldn't concern myself, first off, with competition coming in and outpaying. At the end of the day, your return is set based upon your purchase price, your entry acquisition. So you need to be very conservative when you frame up the discussion with the seller. And when you think about it from a valuation perspective, you really have to look at what is it that I'm buying. I'm buying a stream of cash flow into perpetuity, and you need to value that stream of cash flow. In the business valuation arena, we talk about standards of value, and they're actually quite simple to think through. There's two that I want you to continue to have in your mind. You have fair market value, and you have investment value, or otherwise called the strategic value, right? So there's two of them. And the fair market value of a business is what the business is worth to the current shareholders, nothing more. It's just what is that business worth on a standalone basis. And then the investment value or the strategic value, I tend to use those interchangeably. The investment value of the firm is what that business is actually worth to you, the acquirer. And typically there's a range. Usually fair market value will be substantially lower than the investment value. And there's what we call a value creation zone in between the fair market value and the investment value. And in any sort of M&A transaction, the seller wants to sell for as close to investment value as possible, and the buyer wants to buy as close to fair market value as possible. And so the two goalposts are where a lot of the negotiations take place. So what I'll typically tell our clients is, look, before you start thinking about what the business is worth to you, you need to start and think about what the business is actually worth to the selling shareholders. I'm having this discussion right now at the end of July 2022. We're in a market that valuations are beginning slowly but surely to roll over. And when you think about what goes on in the market, it has been a very, very busy market the last 3 or 4 years, even today. There's a lot of strategic acquirers, private equity firms making acquisitions, and they're focused on larger assets. So pest control businesses that are less than $1 million in revenue tend to have less competition from buyers. For example, rentokil, anticimex, the large strategics in the industry are not spending a lot of time looking at $500,000 and $600,000 businesses, which is great for you because you're unlikely to have competition from the big players. Secondly, the competition that you will have will likely be regionals and other small businesses. Those guys typically don't have much more experience doing deals than you do, so you're not going to really be behind the curve competing with very sophisticated acquirers looking at smaller deals. So, my rule of thumb is I don't care if your business does $1 million in revenue or $50 million in revenue. I think a lot of the value that can be created in these deals by not only getting involved in processes that don't have a lot of competitors, a lot of other buyers, is these smaller deals. Really the kind of the $800,000 to $300,000 in revenue range is a real nice sweet spot for a private acquirer. When you think about the fair market value of the business, it's important to think about you've got the revenue less the direct costs. Then you subtract the operating costs, and you're going to come to some sort of proxy of cash flow, we call it. And in very basic terms, trying to understand what the pre-tax earnings of the business is. And it's very common for owners to attempt to add their compensation back into the P&L. Now, what I say on the buy side and what I say on the sell side are two very, very different things. So when you hear me talk about sell side M&A, I want to throw the kitchen sink back into this. But if I'm investing my own hard-earned money, I'm going to make sure that the P&L, the income statement that I'm looking at, reflects the true costs in the business. And Owners will oftentimes, especially for smaller businesses, not pay themselves, or they might pay themselves a very small salary in order to avoid unemployment taxes and so on and so forth. And it's important to really understand from the get-go what sort of economic benefit is the owner actually providing to that business. So if the owner is paying himself $30,000 a year, but based on all your knowledge of the industry and what it is that you understand that he's doing after discussion, he should be paying himself $85,000 or $90,000 a year. You're ultimately going to have to replace that. And so once you can effectively normalize a P&L, and over the course of the next couple of months, I'm going to provide a financial model for folks in the industry who want to do acquisitions. It'll be free. You can subscribe to our commentary at POTOMACPestControl.com. Get yourself on the list and we'll send it around. But once you build your model and you normalize the cash flow and you say, okay, I have attempted to make this P&L look like a market deal, you're going to come up with some sort of metric of cash flow. At the end of the day, that's really all the seller has to sell, is the cash flow that the business is currently generating.